Hi everyone, I'm happy to let you know that this is the last video in the boring topic about fiscal and monetary policy. And in the last video, we will talk about the monetary policy. As you note in the previous video, the fiscal policy is about how the government collect taxes or and spending with the monetary policy, the story is about the money supply and interest rate. First of all, the monetary policy can be understood as the government influence how money is created. It's very important to know that money creation is not mean that government prints new coins and paper bill. For example, you take out a loan about 10,000 USD and you deposit this kind of money in checking account in the local bank. Once you deposit, you have a balance of $10,000 and you can access it easily whenever you want. This process can consider as the part of overall money supply. The banks that you deposit your money make money by charging interest on the loans, and they can lend part of your $10,000. The maximum amount of money that they can lend to qualified people divided by required reserve ratio. It this rate if this ratio is 10% or 0.1, they are required to keep $10,000 out. I'm sorry, they are required to keep $1,000 out of $10,000 as reverse. In U.S. case, the Department of Treasury is in charge of creating money in form of currency. Secondly, about the monetary policy is how government influence the amount of money in circulation by controlling how high and how low interest rate is. If interest rate increase, less people might tend to borrow money since they have to pay back more money, more interest down the road. If interest rate are low, more people are willing to take out a loan, more money will be in circulation. To put money in circulation, government use other institution. They established and regulate the central bank. In case of US, this is a reserve, Federal Reserve System, or FED. FED yields a tremendous power over the American economy. Whatever they do, whatever they require, the banks respond accordingly. Thirdly, belong to the monetary policy is buying or selling government securities, or it can call as open market operation. Security is the asset that you can trade. Most common government asset is the FED bonds that issued by the government or called IOU. Fed also collecting money and loan money out through federal government. And in a nutshell, monetary economic policy is how the government can influence the money supply and the interest rate through three different tools. They established the nationwide required reverse ratio for all banks in the nation, and they raise or low interest rate or buy or selling government's security or open market operation. So through three video, I have some word to uh, you to take like a takeaway message. And the when we have a less money in circulation, this is a contractory policy. And when we have a more money in circulation, it is expansionary policy. Thank you for bear with me through three video, and I know that it's really boring to you.